David, how are you?
Yeah, good, thanks.
How's the market treating you these days?
Yeah, I think not too badly. Look, there's a lot of mixed signs, I think, and we obviously saw during the reporting season in February, we saw a handful of stocks do particularly well. We saw a handful of stocks do, as expected, and we saw several stocks that probably came out worse than expected. So I think that's going to be more of the same as this calendar year progresses. There's obviously stocks related to the resource sector, and the resource service companies are going to do it very tough this year, I think. On the other side of the coin, you've got that yield play. You've got our parents' generation just searching for yield, searching for sort of a higher return on their cash than they're earning in the banks. And as Joe says, if the Reserve Bank has to go one more time, which I'm expecting by June, that'll probably put a bit of a floor under things. But in the very, very short term, the market's had a damn good run over the last 33 months, but it's had a damn good run in the last 3 months as well. So I think it'll hold fire for a little while.
Yeah, things are looking a little bit expensive, I suppose, and it's hard to find a good value in some of the stocks out there, even though there's some good quality companies still.
Yeah, I think the problem we've got is that the very high quality businesses with the very good prospects, they're sort of, people understand which ones they are, and they've probably bought them up to a large degree. Unless they come up with earnings surprises on the upside, it's hard to keep getting pushed along in share price terms.
Okay. And, I mean, looking at the currency, the Reserve Bank stated today they'd like to see the currency come back a bit more, which could mean, like you say, a rate cut here. But also, if we're looking at the US, a rate increase over there is obviously going to do the same thing. So
Correct.
Do you think they'll be a bit patient and wait for maybe the Fed to do something?
I think they'll wait a little longer. I think... we've had this rate cut in February, and I think to sort of go quite quickly after the February cut, just to me doesn't make any sense. I'd certainly wait a few months. I'd see how things pan out. Obviously now there's an expectation for a Fed funds tightening sometime approximately July. I'd definitely wait a few months and see how things settle down. I think the Australian dollar, is down at 76 now, and it could quite conceivably, over the next 6 or 9 months float down below 70. I think that's definitely on the cards. We saw iron ore now convincingly break through $60 a tonne. All the experts couldn't see it below $100 a tonne 9 months ago. So, so here we are at sub 60. So our terms of trade are definitely under the pump now.
Okay. Good. David, you got an opinion on GR?
Oh, only that they did make one very large acquisition last year, and they sort of had this golden rule: we were never going to pay more than 4 times. I think it was EBIT for memory, and they paid 5 or 6 times EBIT, and I think it was to take what they considered to be possibly a major competitor out of the market. And I think when companies go and break golden rules, you've got to be a bit wary. And I think ever since then, I think certain parts of the market have always been a little bit on the sideline with this one, even though it's been a very well-run business, and every time they do make very large acquisitions, they always have a capital raising behind it, so their indebtedness has never got over the top. But I think, as Joe says, let's look at the organic growth versus the acquired growth, and let's look at things like a figure that we like looking at is the return on incremental equity. So a new dollar of equity, what are they getting on that new dollar of equity, for example?
It's interesting how he suggests that hedge funds shorting it are trying to create margin calls within the stock, but I don't see that. I actually dug out some numbers from the Reserve Bank today, so I'm surprised this sort of question come up, but the margin calls per 1,000 accounts in Australia are about just over 1 margin call per 1,000 accounts.
Yes.
Back in the GFC day, there was about 9.5 per day.
So approximately 10 times more. 10
times more during the GFC to now. And also, I looked at the LVRs on all the margin loans in Australia as well, and they've come back well below 50% now. So whilst during the GFC the margin lending sort of crept up, I think they've been kept under wraps for the time being anyway, until we see another massive bull run, and then people will start tripping over themselves to borrow to get into the market.
Yeah,
again.
We just haven't got into that froth yet, have we? We've got into
No.
a bit of a squeeze where people are saying, gee, I'm earning nothing on my interest rates. I've really got to do something with my cash, my spare cash, but we haven't got that froth yet.
The question I want to ask today is to mainly David Buckland in relation to Big Air Group. Now, I know Montgomerys have always spoken very highly of this company, and I'm more of a chartist than a fundamentalist, so I really would like to know his fundamental views, because it was charting really well, and then the report came out, and lo and behold, it dropped 25%. But as far as I can see, when I look at the report, everything is up. Revenue is up, profits up, underlying NPAT, underlying EBIT, you name it, everything is up quite nicely. Yet the stock's dropped 25%, which is very hard to understand. Now, I'd like to know whether Montgomery still hold it and what did they think of the report.
Okay, David, a question directed to you, a little bit of a confusing one.
Still quite like it there, Anthony. Value it at approximately $1. I did see it sort of pop up quite aggressively a day or two ago. You know, look, it's got pretty decent attributes in that its ROEs are sort of 16 percentage points. I don't think it's sort of overly expensive. Its indebtedness isn't too bad. It's got a pretty decent balance sheet. It's a pretty small business, capped at $160 million. But, you know, we're being patient with this one, and we would say that, you know, it's probably got up to $1 valuation on it.
Good. So, obviously, it may have missed expectations, did it, David?
Yeah, I think possibly at the margin. I think one of the divisions did particularly well and one of the divisions didn't. So in net terms, it probably was a slight disappointment, but not a disaster by any means. And I think with these businesses, particularly these small Aussie businesses, you know, they don't run the businesses by half year or half year or half year. They're trying to take a 3 to 5 year view and transform themselves over the medium to longer term. And sometimes they will miss half year earnings numbers. But you know, in a year's time, their earnings numbers could surprise on the upside. So, you know, I think it's a reasonably well managed business. I think it's got pretty good positioning, particularly in the sort of I'll call it the tertiary education market. And as I say, you know, we would say sort of somewhere between 90 cents and $1 is, you know, it has reasonable upside too, and you know, that's something that we're sort of just going to be a bit patient with in the short term.
On the line from Melbourne. Good evening, Roger.
Good evening, Francesco. I just want to ask the panel's thoughts on stock code ResMed or RMD, in particular what David's intrinsic value is on the stock, and if there's any time, also SEEK, stock code is SEK.
SEK.
Thank you. Okay,
well, ResMed's been a great performer over the years. It's one of those Aussie biotechs that have gone overseas and done really well. So, David, intrinsic value?
Well, it's be fair to say it's a bit lower than the current share price, Roger. You know, look, that was a very, very good half-yearly result, and obviously enjoying the benefits of the declining Australian dollar, US dollar exchange rate. It's picking up very, very good sort of annuity revenue streams with some of its latest products. That said, as I say, the IV is a bit below the current share price. The share price obviously runs superbly. You know, we're always a bit reluctant to just go and, you know, flog a stock blindly, particularly when the prospects we think are sort of so excellent. So I'd have to say it's one that we're sort of debating at the moment, and we're sort of erring on the side of sitting on our hands a little, because we're just often with these really high quality businesses, you look back over a period of years and you sort of say, gee, I wish I didn't sell that. And CSL's a classic case. You know, it's gone from nothing to, you know, many tens of dollars with splits and all sorts of things, and it's fallen back very aggressively many times. But if you just gutsed it out over the entire 15 or 20 years, you would have done well just keeping it in the bottom drawer. And ResMed sort of feels a little bit like that to us. Just quickly on SEEK, what we're seeing with SEEK now is it's really starting to get a little bit more traction outside Australia with some of those international operations. And again, I guess we're probably erring on the side of patience with this one. You know, give it a bit of time. It's a great business, very mature obviously in Australia. Worried long term about the potential challenges from LinkedIn, I'd have to say. LinkedIn has a superb global business model, and LinkedIn, when we advertise for staff, LinkedIn is a lot cheaper than SEEK, and we tend to get higher quality candidates. So just be a bit aware of that. But SEEK looks like it is really starting to do very well in some of its international territories.
Just go back a bit to the valuation of a lot of companies. And you see companies, and you mentioned CSL and ResMed, that have been star performers. And a lot of your analysts sometimes can become very conservative in their valuations, and they tend to chase that value up. Is that what you see sometimes? Yeah,
well, I think with really great businesses, what happens is that probably 3 half years out of 4, they surprise on the upside. So not every half year, but 3 out of 4 they surprise on the upside. And if you just give it time, the intrinsic value tends to rise as those surprises come through. And if you multiply that and compound that over 10 years or 12 years, then you end up getting numbers that 10 years ago you just thought were just impossible. So it's a bit like a steam train that just keeps rolling on and rolling on. It doesn't roll on because necessarily it's superb management. It's just a brilliant company, brilliantly positioned in a growth space and enjoying, say, the internationalisation of its product. And we saw that with CSL, and we're probably seeing that to a large degree with ResMed. So I tend to think with those really, really high-quality businesses, in Australia probably can count them on, 8 fingers. But you tend to basically put them in the bottom drawer unless there is a massive change in the business model and massive deterioration of the outlook.
Okay, so David?
Yeah, I agree with Joe. I mean, Mike, unfortunately, businesses that, where the cash goes out faster than it comes in, unless they keep raising money from their very, very kind shareholders, they tend one day to go broke. So they've got to find, the it thing. And in this case, it's obviously some sort of drug discovery, but it's not just discovering the drug. You've got to then prove it up, get it to market and make sure it's economically viable. So it's like finding, the proverbial needle in the haystack or the mine in Western Australia. Finding the ore is one thing. Getting it out of the ground, getting it to port and selling it is something completely different. And I think generally these are highly speculative businesses. And, unless they're sort of going into very, very strong, positive, reliable cash flow, as far as I'm concerned, you're not investing in them, you're speculating in them.
Yes, Michael, particularly the biotech space. I mean, we were having a bit of a chat off air earlier on about this, and from a broker's perspective, it's difficult to understand a lot of the science. So you've got to be able to follow the news flow and understand what's going on, and particularly when they start doing trials and how effective those trials are. Companies, particularly of an Novogen style, they'll only raise a certain amount of money to get them through a certain phase of testing. Once that's proven up, they'll come back to the market and raise some more. And that's where your dilution comes. But if that drug or process or technology becomes proven and becomes marketable and economical, that's when you start to see real gains. They're companies that you wouldn't put a lot of money into. They're a bit of a punt, if you would like, I suppose. I think we all three of us agree on that. But when they do come off, you tend to get some good gains out of it, but not without the risk. So high risk, high reward sometimes.
Yeah, and if you've got some sort of insight, so for example, if you're I don't know, keep it simple, an interventional radiologist that's using something during a trial and you're seeing very, very positive results with your patients during that trial, and you're seeing it time after time after time after time, then you've got some sort of insight that the people in the Australian market don't have. So you may have some sort of information advantage, but unless you have that information advantage, I think it's you're merely speculating with these things.
Heavily, can you see them sort of starting to build a bit of a platform and moving north on their current valuation?
Well, I think you're right. I think they're moving into a favourable environment. Dave, what do you think?
Yeah, well, obviously, we've had this massive bull run in compression of interest rates in the US, and as Joe says, with unemployment rate going from, approximately 10% to approximately 5% by the end of this calendar year, that declining interest rate cycle, all things being equal, should be coming to an end sooner rather than later. So that'll certainly start assisting QBE with their float and the like, and particularly given, they have such a large operation in the US. But, it's a business that was, I guess, it was a business that was loved by the Australian market. It then has been sin bin for several years. It's missed its earnings on numerous occasions in recent years. And I think for the first time it looks like it's actually starting to sort of produce some solid numbers again. So I think the market will want to give it a bit of time to see if it can string 2 or 3 half years together. But it's certainly one that, you should put on the watch list.
Yeah, I think they hit a bit of a, pardon the pun, perfect storm there with the GFC, then declining interest rates. The currency went against them for Australian investors anyway, and also they had some large claims in different areas around the world as well. So that all went against them.
And most importantly, they also had some very severe write-downs of past acquisitions, and they were very severe.
Yeah. And I think the decks have been cleared, do you?
Well, you never know with insurance companies. They're black boxes, but certainly they're clearer than they were a couple of years ago.
George writes, looking for advice regarding whether it is a good time to buy in Fortescue Metals. David, we talked about
I think
steel.
this is a very simple call. I think you've got to have an assessment of where iron ore is going. And if you think iron ore is going to sustainably go back towards $80 a tonne, then Fortescue is a highly operationally and quite financially leveraged business that will enjoy the rally in the iron ore price. But I fear that, and the Montgomery House has been very negative on the whole iron ore stroke steel space now for a couple of years, and we don't think there's any reason to change that view. So iron ore, is now down in the 50s. It could quite easily get down to the low 50s over the next 6 months. We know that China's a massive exporter of excess steel. We understand that they're producing and exporting now, well over 100 million tonnes of steel and just dumping it around the world. So I don't know if that augurs very well for the iron ore price in the foreseeable future. And most importantly, we've also got to remember that with the operations in Australia from the 3 or 4 majors, plus with Vale, there is a lot more supply coming on over the next 18 months.
And very, very low cost.
At very low cost.
They're all reducing their cost bases.
Yeah, so until the high marginal producers in China, who are up around 80, 90, $100 a tonne, are closed down, and I don't think necessarily the Chinese government will want to close them down in the short term. Until they're closed down, I think it's very hard to get bullish on the likes of Fortescue. As I say, it's a highly operationally and financially leveraged business, and you're basically taking a punt on whether iron ore goes back to 80 or not.
Okay, so just in the healthcare sector, what are your favourites at the moment, David?
Oh, well, look, we still own ResMed. We own Certex. We've been a long-term supporter of that company, and there's obviously the Surflox trial announcements coming out very near term, and then the ASCO conference in Chicago, which is really amongst the radiologists and the oncologists, where we'll actually get the meat on the skeleton. Is this Surflox trial, which is 532 people, extraordinarily successful, quite successful, or just successful?
So I read something today, though. The outcomes are, if it's positive, we could be seeing $50 on this sort of stock.
Oh yeah.
If it's negative, we could be seeing it halve. So
Correct.
It's a very big movement.
It's
there.
a binomial result.
Yes.
And we probably won't know the meat on the skeleton until the ASCO conference in June.
Sure.
But the bottom line is, I actually think if it's all positive, $50 will prove very conservative. But you're absolutely right. If it remains only in the salvage setting market for second-degree liver cancer, that'll promote great disappointment within the share price.
Okay.
So other Ramsay Healthcare, we're still there.
That's run well, hasn't it?
It's been a superb business.
Australian Pipeline Authority and Transurban, if I could get your expert panel's opinion on them, please.
Sure, a couple of infrastructure stocks that have performed well in recent times. Yeah. David, what are your thoughts?
I think in both cases they've enjoyed a massive compression of interest rates, because with these infrastructure assets effectively get a very, very reliable earnings stream, very reliable cash flow. It's predictable, and also it often increases at inflation or a tiny bit more than inflation. So, they're not sort of super exciting businesses, but they're highly predictable and highly reliable businesses. But on the other side of the coin, they have fairly low return on equity, but they also have huge debt in general terms. So I'm just looking at, say, APA, its indebtedness is something like 200% gearing. But what actually happens is, as interest rates come down immensely, which they've done in recent years and certainly in recent 6 or 12 months, they enjoy the sort of the translation benefits, and the market sort of suddenly gets very excited about these sorts of stocks. So I would say, it's been a great ride, but just be aware that if interest rates reverse and normalise at some stage, the sex appeal that's really driven a lot of these stocks the excitement will come out of these stocks to a large degree, and so I just think you should be a bit aware that they have enjoyed this one-off massive compression of reduction of interest rates.
And Joe,
Maybe somewhere.
okay, and David, your thoughts on
Well,
Flight Centre?
you know, it's gone from very recently the low $30 area to the low $40 area,
Sure.
and I think, you know, very, very long term, you know, Flight Centre enjoys the fact that Australia's a cul-de-sac.
Yes.
So whenever we have to go and fly internationally, and it's a complicated route, we have to walk down to Flight Centre and say, gee, this is complicated. I can't just jump online. Whereas if you're in Germany and you want to go to Belgium, you know, online. If you're in, you know, France, you want to go to Spain, online. So they enjoy the fact Australia's a cul-de-sac. That won't change in the very immediate term, but very, very long term, as online jumps over those complication hurdles, I think these guys will be a little bit challenged. So I would sort of, we do own it. It's a much smaller holding for us than it was, particularly with the rally through the $40, $41, $42 area. But it's one that we're saying to get a little bit wary of, I'd say.
Okay. You think people are paying a margin for the service at least?
Yeah,
or happy to pay a margin for the service?
I do. I mean, I just know. I just know whenever anything's complicated, particularly if you're spending a fair bit of money. If you're not, say, a student where the timing and all that sort of stuff is irrelevant, but I think for people with families where they have to be at A and then they have to get to B on certain time, I think, you know, it's a good business model. But as I say, if we're in Germany or in Western Europe, it would be probably a very different value proposition.
Okay, great. Well, that's all we have time for today. Thanks so much to our guests, David Buckland from the Montgomery Fund and Joe Mayer from the Motley Fool.